Welcome to the Deep Dive. We take the research you send us, analyze it, and give you the essential insights. Today, quite a challenge ahead of us. We're looking at Avenue Supermarts, the company behind DMart, the huge Indian supermarket chain. And we've got a really rich stack of sources here: strategy docs, expansion plans, operational metrics, and financials right up to H1 FY26, so ending September 30, 2025.
Yeah, it's quite comprehensive. And our goal today isn't just to admire the growth, right? We want to understand how they do it. How does DMart actually execute its core strategy for that consistent growth? And crucially, what do these latest numbers, especially the slightly tighter margins, tell us?
It's a fascinating story. I mean, starting with just one store in Mumbai back in 2002.
Maharashtra.
And now, a massive chain. You can get pretty much anything for your home there.
And it all comes back to one core idea, a principle that seems to drive everything they do. We should start there. It's their foundational model. Everyday, low cost, everyday low price. EDLC, EDLP.
EDLC, EDLP. Okay, we hear EDLP, everyday low price, a lot from retailers.
Well,
But you're emphasizing the EDLC, the low cost part. What does that actually look like? How do they make sure they're the cheapest to run?
it's about being incredibly frugal internally. So yes, getting goods at great prices, often going straight to the source, bypassing middlemen. But the real kicker, the thing that jumps out from the sources for DMart, is their focus on owning the property, owning their stores.
Ah, okay. So not just renting space in malls or high streets.
Right. By owning, they avoid rising rents over the long term. It fundamentally lowers their operational cost base compared to competitors who rent.
That's smart. It means the low cost isn't just about temporary deals. It's built into their actual infrastructure. Makes the low price sustainable.
Exactly. It's baked in. Then add obsessive efficiency in distribution, no frills stores. And then they pass the value to you, the customer. And they deliver this across their three main categories: foods, non-foods, FMCG, and general merchandise and apparel.
Okay, so that's the strategy. Let's talk scale now, because the footprint growth is just, wow. End of Q2 FY26, so September 30, 2025, 432 stores operating.
432. And that translates to 17.9 million square feet of retail space. It's vast, but again, it's how they grew that's key. It wasn't random. It's this disciplined cluster strategy.
Right, the cluster approach. That really seems to be the secret sauce for their market dominance. Let's trace that quickly. Back in, 2011, 12? Only 55 stores.
Yeah, tiny compared to now and heavily concentrated, right? Maharashtra, Gujarat mostly, building strength region by region.
Okay, fast forward. H1 FY24-25, they hit 377 stores.
And then just 1 year later, H1 FY25-26, they're at 432. That's 55 stores added in 12 months.
55. That maintains their pace, doesn't it? They were adding 40, 50 stores a year pretty consistently before that, too. FY22, 24, 25.
Absolutely. The pace is relentless. Even in the first half of this fiscal year, FY26, they added 17 stores.
17 in 6 months, with 8 of those opening just in the last quarter, Q2. So the build-out machine is still churning.
Definitely. But look at where they're building. The big shift highlighted in the sources is the focus on dense urban markets, large towns.
Yeah, that seems critical. A decade ago, basically just Mumbai MMR.
One city cluster.
Now, by H1 FY24-25, they were in 24 cities. The latest H1 FY26 number is 19 cities listed, but still focused on those big population centers.
Places like Jaipur, Pune, Bangalore, Hyderabad, Nagpur, major hubs.
So why is hitting these big, expensive cities so vital for their cluster model? Doesn't it drive up costs?
It does initially, yes.
Right.
But it's essential for the EDLC part, for efficiency. Think about it. If you put multiple stores in, say, the Pune area, you drastically cut your distribution costs for that whole cluster. You can serve several high-volume stores from maybe 1 or 2 nearby distribution centers.
I see. Fewer, bigger warehouses serving tighter groups of stores,
Yeah.
maximizes truckloads, reduces travel time.
Exactly. Maximum efficiency within the cluster before they move on to dominate the next city. It lowers costs and lets them control the market faster.
Okay, so strategy. Low cost via owned real estate and clusters. Execution. Rapid, targeted urban expansion. Now, what are people actually buying? Let's look inside the cart at the revenue mix for H1 FY26.
Right. The big one, no surprise, is foods. It's the anchor. In the first half of FY26, foods made up 57.01% of their revenue. Interestingly, that's actually up a tiny bit from 56.40% the year before.
57%. And that's all your basics, right? Groceries, staples, dairy, fruit and veg, oils,
Yeah,
the everyday needs,
precisely. The stuff you buy every week, maybe even more often.
which guarantees that high foot traffic. You need rice, you need milk. DMart aims to be the cheapest place, so you keep coming back.
That's the core loop. Then you have the other categories filling out the basket. Non-foods, which is your FMCG stuff.
Home care, personal care, toiletries.
Yeah. That category saw a small dip. It went from about 20.15% of revenue down to 19.65% in H1 FY26.
Okay, a slight shift. And general merchandise and apparel. The plates, towels, clothes, toys.
That held pretty steady, just a tiny dip from 23.45% down to 23.34%, so call it stable.
So here's the interesting insight for you, the listener. DMart is expanding like crazy, right? Normally you'd expect a retailer doing that to push higher margin general goods more.
Right, because apparel and home goods usually offer better profit per item than, say, potatoes or flour.
But DMart isn't doing that aggressively. Their reliance on low-margin, high-frequency foods is actually stable or even slightly increasing.
It suggests they're being very disciplined. They're probably resisting the urge to stuff stores with slower-moving, higher-margin items that could mess up their inventory flow.
They're prioritizing throughput and traffic over maximizing the margin on every single sale. It fits the EDLC, EDLP model perfectly. Efficiency first.
Exactly. Keep the engine running smoothly.
Okay, which brings us perfectly to the money, the financials. We know the strategy, we see the execution. What did it cost them, and what are the returns? Let's look at the operational numbers for Q2 FY26 first.
Operationally, the scale is just immense. In Q2 FY26 alone, they processed 9.7 million CR's bill cuts, essentially transactions.
Almost 10 million crore transactions. It's mind-boggling volume. But the real health check for existing stores is LFL growth, right? Like for like.
Yes, like for like. That tells you how stores open for more than 2 years are performing. Are they still growing on their own?
It strips out the growth just from opening new stores. So what was the LFL?
For Q2 FY26, LFL growth was 6.8%, which is, pretty solid.
6.8%, that's healthy. It shows the existing stores are still pulling people in. The EDLP promise is working.
And they're using their space well. Revenue per square foot was INR 8,692 in Q2 FY26. Strong utilization.
Okay, good operational health. Now, the overall financials for that quarter, Q2 FY26, top line looks good?
Yeah. Total revenue hit Rs 16,219 crore. That's up 15.4% compared to the same quarter last year. Strong growth.
15% growth, solid. But here's where we see the impact of that expansion, right? Profitability.
Exactly. Let's look at EBITDA earnings before interest, taxes, depreciation, amortization. It grew, yes, to Rs 1,230 crore, up 11.3%. But the margin tells the story. EBITDA margin was 7.6% in Q2 FY26. That's actually down from 7.9% year earlier.
Slight squeeze. And the bottom line, PAT, net profit.
Similar story. PAT grew 5.1% year over year, reaching Rs 747 crore. Again, the PAT margin contracted. It was 4.6% in Q2 FY26, down from 5.0% in Q2 FY25.
So growing fast, but profitability per rupee of sales getting a bit thinner.
And this isn't just a one-quarter blip. The sources show a trend if you look back further. EBITDA margin from operations was higher, around 8.7% back in FY22. Now it's down to 7.9% for the first half of FY26.
And PAT margin?
Same direction, down from 6.1% in FY22 to 4.9% in H1 FY26.
Okay, so definite pattern. Rapid growth, efficient stores based on LFL and revenue per square foot, but noticeable pressure on margins, which leads to the big question. Is this margin dip a problem or just the cost of doing business when you're expanding this aggressively, especially buying up land?
To answer that, you have to look under the hood at their efficiency engine, the key ratios.
Right. How well are they managing their assets and operations day to day? This should connect back to that EDLC focus.
It does. And this is where DMart really impresses. Let's start with inventory. How long does stuff sit on their shelves? Days inventory has actually improved. It's decreased from 33.3 days back in FY22 down to 31.4 days in H1 FY26.
Okay, they're turning over stock faster. Almost 2 days quicker than a few years ago. That's significant in retail.
Yeah.
Less cash tied up, less waste.
Huge efficiency gain. Now, flip side. How quickly do they pay their suppliers? Look at days payables. That number has increased. It went from 7.7 days in FY22 up to 8.3 days in H1 FY26.
Ah, interesting. So they're taking slightly longer to pay their bills, getting more credit from suppliers.
Effectively, yes. They're using their massive scale to negotiate better payment terms. It's like getting a small free loan from their vendors for an extra half day or so. That's operational muscle.
Okay, faster inventory turns, longer supplier credit. What about their big physical assets, the stores they own?
That's probably the most dramatic number. The fixed asset turnover ratio. This shows how much revenue they generate for every rupee invested in fixed assets like land and buildings. That ratio has basically doubled. It shot up from 3.1 in FY22 to 6.3 in H1 FY26.
Wow, doubled. So the stores they own are working much, much harder now, generating way more sales relative to their initial cost. That owned real estate strategy is paying off in utilization.
Phenomenal leverage from their infrastructure. But here's the paradox we need to understand. Despite these fantastic operational improvements, faster inventory, more supplier credit, assets working twice as hard, the overall returns on the money invested are actually shrinking slightly.
Right. Let's look at those return ratios. Return on net worth, RNW.
That's down from 20.1% in FY22 to 17.6% in H1 FY26. Still very respectable, but lower.
And ROCE, return on capital employed, the big one, showing return on all the capital invested.
Also down from 15.6% in FY22 to 14.1% in H1 FY26.
Okay, so this is the core tension. Operationally sharper than ever in many ways, but overall returns are dipping. Why?
It comes directly back to that aggressive expansion and the strategy of owning real estate. When DMart opens 17 new stores in 6 months, buying land and constructing buildings, especially in expensive cities, that requires a massive upfront cash outlay. Huge capital expenditure.
Right, that new investment goes straight into the capital employed denominator of the ROCE calculation.
Exactly. So even if the existing stores are performing brilliantly, adding billions in new, not yet fully productive capital makes the overall return percentage dip temporarily.
It's like an investment lag. The costs hit the books now, but the full revenue and profit contribution from those new stores takes time to ramp up.
Precisely. The drop in ROCE and RNW isn't necessarily a sign of operational weakness. It's more the mathematical reflection of pouring capital into future growth via their cluster and ownership model.
They're choosing long-term structural advantage, lower costs forever, because they own the land over maximizing profit percentages in the immediate short term.
That seems to be the trade-off they're making.
Okay, so let's try and synthesize this for you, the listener. The big takeaway here seems to be DMart's continued success really hinges on this disciplined, cluster-based expansion, powered by that relentless EDLC focus. We see proof in the strong fixed asset turnover, they sweat their assets well, and the tighter inventory days. Operationally, they are sharp.
But, and it's an important but, that very aggression and expansion, especially because they insist on owning property, puts downward pressure on the overall profitability ratios like margins and ROCE in the near term. It's simply the cost of funding that future dominance, buying market share and low-cost structure for the long run.
So we end where we began, almost. We see the strong store growth continuing, 17 added in just 6 months. We see the operational machine humming, but we also see those slightly thinner margins and returns, which leads us to a final provocative thought for you to consider. Given how central owning real estate is to DMart's EDLC strategy and the clear structural advantages it provides, at what point might we expect these return metrics like ROCE to bottom out and start climbing again?
Yeah, when does the drag from all this new capital investment lessen? When do those new store clusters mature enough to significantly lift the overall company profitability back towards those historical highs?
What does that inflection point look like for a retailer making such huge long-term bets on physical assets?
It's the classic growth versus profitability balancing act. Finding that sweet spot is the challenge.
Definitely something to think about. Thank you for joining us for the deep dive.